Welcome to another episode of Money Talks for Life, where we break down the financial systems that shape your future. I'm your host, and today's episode covers something that surprises a lot of people: accessing money from your 401k while you're still working. Yes, that's right. Under certain conditions, you don't have to retire or quit your job to take money out of your 401k. But the rules can get complicated, and making the wrong move might cost you more than you think. In this episode, I'll walk you through the three main types of in-service withdrawals, what types of money you can access, how much you can withdraw, what order the funds come out in, and finally, how taxes play into all of it. Let's start with the basics. Segment 1. What are in-service withdrawals? A 401k is built to help you save for retirement, but sometimes life doesn't wait. You might have a financial emergency, or you might be approaching retirement age and want to start drawing down your funds slowly. That's where in-service withdrawals come in. An in-service withdrawal means you are still employed but want to access money from your 401k plan. The catch? Employers aren't required to allow it. Some plans offer flexible options, while others don't allow in-service withdrawals at all. If your employer's plan does permit it, you need to know this up front. The money you withdraw cannot be paid back. It's not like a loan. Once it's out, it's out. And unless you roll it over into another qualified account, it's considered taxable income. Segment 2. Types of withdrawals. While employed, there are three primary types of in-service withdrawals, each with their own rules. First, the regular or ordinary withdrawal. This is generally the most restrictive. You can typically withdraw after-tax contributions and earnings, but you cannot withdraw any before-tax employee contributions, Roth, 401k contributions, or their earnings. Some plans also limit or restrict employer contributions under this withdrawal type. Second, we have the hardship withdrawal. This is for immediate, heavy financial need, like avoiding eviction or paying for funeral expenses. If permitted, it allows access to most money types in your plan, but with one big exception: you cannot withdraw earnings on your before-tax contributions made after 1988 or any earnings on your Roth 401k contributions. Everything else is generally available, including after-tax, rollover amounts, and some employer contributions, depending on the plan rules. Finally, there's the age 59 1-2 withdrawal. Once you hit that milestone age, the doors open wider. You can generally access all money types in your 401k, including before-tax contributions, Roth contributions, employer matches, and rollover funds. Most restrictions fall away at this age. Segment 3. Types of money in your 401k. So, what exactly is in your 401k account? There are usually 5 types of money: before-tax contributions that you've made, along with the earnings on those contributions; after-tax contributions, if your plan allowed them, and their earnings, Roth, 401k, contributions and their earnings; employer contributions, such as company match or discretionary profit sharing; and finally, rollover amounts, which are funds moved into your 401k from another qualified retirement account. Unlike loans, there's no fixed limit from the IRS on how much you can withdraw through an in-service withdrawal. Your limit depends entirely on what types of money you have, what's vested, and what your employer's plan allows. For example, a regular withdrawal might only give you access to after-tax contributions. A hardship withdrawal might give you more, but not all. An age 59 1-2 withdrawal usually allows access to everything. One important note: some plans have extra restrictions on employer contributions. A common example is the 24-month holdback, which means that employer matching contributions must stay in the plan for 2 years before they can be withdrawn. Some employers restrict these contributions to only be available at age 59 1-2. Segment 4. The order money comes out, the hierarchy. Now let's talk about the withdrawal hierarchy. That's the order in which your plan pulls the funds when you request a withdrawal. You don't get to pick and choose what comes out first. Your plan follows a set sequence, usually starting with the most flexible or oldest contributions and ending with the most restricted. For example, the plan may first withdraw any after-tax contributions that were grandfathered and had no earnings. Then it would move to non-grandfathered after-tax contributions and their earnings. After that, it might pull from rollover contributions, followed by company match, then company discretionary contributions. After exhausting those, the plan may finally dip into your before-tax or Roth contributions that are eligible for hardship. And the very last to be touched is the full value of your before-tax or Roth contributions that become available at age 59, 1.2. Each type builds on the last. So the more permissive the withdrawal option, the more money types you can access. You always start with the most unrestricted money and move down the list. Segment 5, taxes on withdrawals. Now this is the part that gets tricky. Taxes. Let's break it down. First, any taxable money withdrawn from your 401k becomes part of your income for the year. You don't pay tax while the money stays in the plan. But once it's out, it's taxable, unless it's from a Roth account and meets qualified distribution rules. Now, for most withdrawals, the IRS requires 20% of the amount to be withheld for federal income taxes unless you do a direct rollover. This withholding acts as a prepayment on your taxes for the year. But remember, 20% is just a standard. You might owe more or less depending on your total income, deductions, and exemptions when you file. Hardship withdrawals are an exception. Here, instead of a 20% withholding, the IRS allows you to opt for a 10% withholding instead. But that doesn't mean your tax bill will be lower. It just reduces what's withheld up front. Second, there's the 10% early withdrawal penalty if you're under age 59, 1.2. This is on top of income taxes. The plan doesn't withhold this penalty automatically. You'll owe it when you file your tax return. There are exceptions to this 10% penalty, things like total and permanent disability, certain medical expenses, or a qualified domestic relations order. But the rules are detailed and plan. Administrators or service reps should never tell participants whether they qualify. Always refer participants to a tax advisor or the IRS website. Lastly, every withdrawal triggers an official tax form, the IRS Form 1099-R. You'll get it in January following the year of the withdrawal. It shows the total amount you took out, what portion was taxable, and how much was withheld in federal and possibly state taxes. The IRS also gets a copy, so make sure it matches your tax return. Final segment, smart withdrawal strategy. So, what should you do with all this information? First, know your plan. Your employer decides what's allowed. Read your summary plan description or talk to your benefits team. Second, understand your money sources. Know what's vested and what's available. Third, consider the tax impact. Use calculators, or better yet, speak with a professional. Fourth, look at other options like 401k loans if your situation allows it. Loans are not taxable and can be repaid, and most importantly, make any withdrawal decision with your future in mind. It's your retirement. The goal is not just to access the money, it's to keep it growing until you truly need it. That wraps up this episode of Money Talks for Life. If you learned something new about your 401k, consider sharing this episode with a coworker or HR professional. These are the details that help people make better choices. And remember, this content is for educational purposes only. For the most up-to-date rules and changes, always check the official IRS or Department of Labor websites.